The market is going to surprise a lot of investors in the next 12 months, and I want you to be prepared. Jerome Powell just said that stocks are fairly highly valued. I'm gonna show you that article, and I'm gonna also show you the S&P 500 PE ratio because it keeps climbing higher and higher every week. So their valuations are getting overextended. I'm gonna show you what the impact on the market is in the next 12 months in the short term. And I'm gonna give you my price projections on exactly where I think the market is headed from here. But remember, this is not financial advice. I'm just sharing what I'm personally doing for educational purposes only. Results may vary. Now let's take a look at the portfolio. As you can see, we're near all-time highs, kind of hovering around this area. But if you do wanna see me hit my 8-figure goal in this portfolio, make sure to be subscribed by clicking the subscribe button down below. And also, if you get any value out of this video, I would greatly appreciate it if you hit the thumbs up button for me. I appreciate you being here. So let's go ahead and go into the realized gain loss because today, current month, 48K, definitely hitting my goals there. Today, we had a decent day of 2,660. Now, remember, these results vary month to month, depending on risk tolerance and market conditions, but I'm not the only one doing it. As you can see here in my private mastermind options trading university, we now have 387 clients sharing their inspiration. As you can see, clients posting their accounts, different, obviously they have different account sizes and risk tolerance, but I love it when people share their inspiration, especially new clients like this one right here. This is his first month. So yeah, if you do want access to the Discord and you want access to my Ryan's Trades channels and my Leaps entries and exits, that'll be at the top of the description. Also, I do give away free trade ideas on my Instagram and my free newsletter, which are both down below. So make sure to be subscribed to both of those because I share things that I don't share here on YouTube on my Instagram and my newsletter, okay? So let's dive into it. Fed Chairman Jerome Powell says stock prices appear fairly highly valued, okay? What does he mean by that? Well, he's basically saying that stocks are a little bit overpriced here, a little bit overextended, considering where we're at with the economy, okay? But at the end, he did say, though Powell noted lofty equity values, he said this is not a time of elevated financial stability risks. So he's not worried about the economy as far as the Fed being able to step in, lower interest rates if needed to stimulate the economy, okay? So, but he did say stocks are fairly highly valued. So we're gonna talk about that and what I think about the markets, all right? We do have interest rate cuts on the way. CME FedWatch tool pricing in an interest rate cut 94% for next month and 76% for December. So 2 more on the way as indicated by the Fed. But next year, there's also 2 more being priced in on the CME FedWatch tool, which wasn't indicated by the Fed. In fact, they said probably only 1 rate cut for 2026. So that's why I like to look at this tool because as interest rate cuts, as interest rates get lower, businesses can borrow at cheaper rates, consumers can borrow at cheaper rates, causing more spending, okay? And this causes equities to go higher. Now, if we take a look at the US economic calendar, today we had kind of a surprise on US home sales, okay? So new home sales came in 20% higher than expected. And my theory on this is that people are front running the markets, not only equities, but homes as well, in properties because there's a lot of money sitting on the sidelines, number one. Number two, they could always refinance as interest rates are being cut because obviously the Fed indicated they're cutting rates. So people are front running, okay? And I think that's happening in the markets as well as we've seen stocks get pushed up to very high value. So what we're looking at right here, okay, and it's gonna be a longer video, so definitely take notes if needed. But we're looking at the S&P 500 PE ratio, okay? So the average PE ratio of the S&P 500 right now is sitting at 30 times earnings. So people are paying 30 times what these companies, these 500 companies actually earn to own them. So what does that mean? Well, we're a little bit higher than we were before. The average S&P 500 PE ratio is somewhere between 16 and 18, okay? So we are double that right now. All right, back in 2022, during the bear market, we were at 20, okay? And we've seen it even lower, like back in 2011, we were at 13, all right? So there's been lower periods where the stock market was undervalued. And right now we are technically overvalued. But I do want to point out something, because if you look at the PE ratio average, it's just been increasing ever since the 1970s. And why is that? Well, that's when we got off the gold standard and we started printing more money, okay? So you do have to factor that in, because as money is being printed, it has to go somewhere. And usually that money chases assets, whether it be real estate, commodities, or equities, all right? And now cryptocurrencies. So the money has to go somewhere, which in theory pushes asset prices up and causes them to be overvalued over time. As you could see, right? PE ratios have consistently gone up year after year, sometimes getting way overextended, and obviously having fluctuations like here in the dot-com bubble, right? The PE ratio on the S&P 500 was over 100. It was 120, okay? So we are nowhere near there, okay? We're nowhere near bubble territory. And I do want to show you a few things, okay? So we have the 10-year treasury yield, all right? Let me switch this back actually to candles. All right, and the 10-year treasury yield is at 4.1%. So these yields are heading downwards. This is where investors go for risk-free returns, right? Which is US government bonds. All right, the only risk is if the US goes under, which is next to 0%. So these yields are going down, which means right now, investors are kind of flooding into bonds to get that last bit of high yields, because eventually these will come down as interest rates come down as well. Okay, and you could see like previous periods where if we go, back to, let's just say 2018. I remember in 2018 we had a big crash, right? Because the Fed indicated that they weren't sure if they were going to cut rates, but then they decided to. Okay, and you could see the treasury yields came down as well. And 2019 actually was a very good year, a very bullish year, as interest rates and yields came down on the 10-year treasury. We aren't even close to 3% yet, okay? Once we break this 4%, my theory is that a lot of this money is gonna flood out of risk-free assets because the yields are lower, right? That money has to chase something that's going to basically provide a better yield, which is in real estate or equities, okay? And I think that's what we're going to see, okay? If we look at the S5FI, which is S&P 500 stocks above their 50-day moving average, we are at 56%. So half the market is still not above their 50-day moving average, so we're not overextended here. I think we're overextended in certain sectors like AI and technology, and that money will rotate out of those names into others, but for right now, we're not looking overextended. If we look at the M2 money supply, all right? This is all the money that's available circulating in the economy, $22 trillion. This is all-time highs for August, okay? All-time highs. But if we look at the money markets, okay, the money market funds, this is total cash sitting there in money market funds, financial assets, cash just sitting on the sidelines. There's about 7.4 trillion, which is a new record all-time high. Okay, so as the more money is being printed, the money market funds are also increasing because no one is taking that cash and investing it into equities just yet. Okay, and I want to show you a period where these money market funds were flat or even kind of trending downwards here from March 20th to July 22nd, okay? Flat, yet the money supply from April 20th or April 2020 to July 2022 was increasing. So money supply was increasing, like money was being printed, but money market funds were staying flat. Why is that? Because that money was chasing assets, okay? And we are, I believe, approaching that level where I believe money, these $7 trillion will start chasing assets and start decreasing a bit, maybe trade sideways as we print more money. And I want to show you QQQ during that time, okay? So if we go back to, okay, April 2020 was right here during the COVID. Let me actually move this. Okay, let me move this. And you'll see, okay, April 2020 was right here. What did the market do all the way to July 2022, okay? Or actually, really January 2022. it just kept going up. Okay. So that's my expectation, is that we are going to see those money market funds flow into the market, and we're going to see valuations that may surprise a lot of people. And I've seen this happen before where valuations get very, very overextended. So what is my thought process on the markets right now? In the next 1.5 to 2 years, I think the market is going to be very bullish. That's just my potential expectation. Okay, that's my expectation. Now, could we see corrections and potential crashes along the way? Sure. That happened not too long ago, right? Tariff crash back in April, right? That was a 25% crash. Now, what I'm expecting here in the short term is that we actually have a nice pullback. Now, we're getting a little one today, okay? I don't know where it's going to end up at the close, but if we have a nice 3 to 5% pullback from all-time highs on QQQ, okay, that would bring us to this area, about the 570, 575 area, okay? That's kind of the downside expectation there. I don't expect a 10% correction here. Now, if we continue, if this is it, and we continue heading higher, and we go all the way up to 620 or something like that, then I think a 10% correction, 10 to 12% correction is more feasible, okay? So what am I doing now to prepare for those potential corrections to get into my favorite stocks? Because long-term I'm bullish and I think the market's going higher. Okay, well, I'm keeping my VIX cash allocation levels in line. Now, right now VIX is climbing, okay? Fear is rising. We're at 16, basically 17 on the VIX. Okay, this thing could easily pop into the 20s like boom, overnight, right? So how am I preparing for that? Well, I'm following my VIX cash allocation levels. If you see right here, we're between VIX 15 and 20, so there's slight fear right now. I have around 18% cash. I could have 20 to 25% essentially. That would be more conservative and probably better for a dip. So I'm trying to get my cash levels up higher for that, in preparation for that next potential correction or dip, okay? VIX 20 to 25, if we get there in the next week or so, I'll be 10% cash, right? I will be light on my cash because I'll be investing into the market as it's coming down. And I'm gonna show you exactly how I'm doing that and which stocks I'm doing that in. So let's go back to the markets, and I'm gonna talk about two stocks right now, okay? Two really good opportunities. The best one, I think, well, I'm not gonna say the best one. I think this one has a lower risk profile to it, in my opinion, is Amazon. Okay, Amazon touching the lower Bollinger Bands on the daily time frame. It's almost oversold on the RSI, all right? And the PE ratio is in the 30s, low 30s. Back here when Amazon was trading at, in the 240s, the PE ratio was in the high 50s, all right? So, Amazon has only gotten better as a company since then. In fact, if you go to their quarterly results, their Q2 quarterly results, and you actually read through them, okay, they had negative free cash flow of 66% year over year. So negative 60%, right? But that means that they're investing that cash into something. And if you go through it, okay, you could see they invested into Alexa, okay? They invested into their AI models like Deep Fleet that optimize productivity paths for 1 million robots, okay? They invested into their making it much easier for software developers to write code with Kiro, their new agentic IDE to build AI agents, okay? Just go through this list. Many, many things, okay? A lot of AI investments going on with Amazon. And typically, I don't believe Amazon is looked at as an AI company. I think people think of it as a logistics company where people buy their goods and get it to their home as fast as possible. But a lot of their operations are potentially going to be replaced with robots, okay? So think about the delivery, think about the warehouses, right? All of that, all of that plays into the logistics. So I think right now Amazon hasn't seen their run yet, and they haven't even breached their previous pre-tariff all-time highs, okay? Like we saw in Google. Google was a slow mover. PE ratio was super low. They hadn't breached their previous pre-tariff all-time high. And then boom, they just broke out, right? And went up like 25, 30%. So Amazon hasn't had that move yet. And I think that is coming for Amazon by next earnings, which is the last week of August, all right? So I'm gonna show you how I'm playing it. Remember, this is not financial advice. I'm just sharing what I'm personally doing for educational purposes. Only results may vary. But if we take a look at the account, okay, basically, I have 180,000 in cash secured puts. This is the largest position I've ever taken on Amazon. But I like it at 225, 230, 222 and a half, 220s. But right now, if I wanted to play earnings, I'd go out to the last week. Implied volatility is high, right? Expected move is $22, so it could go up to 242 or down to 198. That's the market maker risk. But right now, if I sell the 220, I'm picking up $915 with a potential ROI of 4.3%, depending on where the stock is. Obviously, results vary there. But I like that. And in fact, I did that trade, okay? I have one of those. All right, so that's my play for Amazon in expectation that it's gonna go up to 240, 250, 260. And that's just my play there. Now, the next one is Palantir. All right, Palantir, I think hasn't, it is definitely extended here, but it hasn't ran up to an extreme where, we're super overbought on the RSI, like back here where it's like lit up green, right? We're actually within range of the RSI. So I think right now is a good opportunity to potentially snag Palantir at a discount. So what I did in the portfolio here is I went to the Palantir 165s. I just moved my whole position up to 165. I went out to October 31st and I sold the 165s, collected $600 for a potential 3.8% ROI. Results vary there. Okay, so that is my play there on Palantir. And what's cool about that is if I get assigned Palantir, if the stock falls below 165 by expiration, that's my risk. I get it at a 13% discount from all-time highs. And my expectation on Palantir, now that they just secured a new contract with Boeing, okay? Boeing, yes, the company that the government bailed out during COVID, okay? Deployed across Boeing defense, space security partners, right? Palantir's Foundry AI system integrates complex data, streams into a single intuitive one-stop shop interface, right? Boom, big deal with Boeing. That's huge. So very bullish on Palantir, and I think it's going to be a $200 stock by the end of the year. So that's my expectation for Palantir. Of course, it could be lower, could be higher, but that's my expectation there. If you enjoyed this update, please give it a thumbs up, and I'll see you in the next one. Take care.